Ever wondered what your $1,000 investment in SoundHound back in 2022 is worth now in March 2024? If you did, you're not alone. Many are curious about the growth of their investments, especially in dynamic companies like SoundHound, and it's not just about the numbers, but understanding the reasons behind them. So buckle up and hold on to your seats as we dive into the financial and business analysis of SoundHound. Let's demystify the factors that led to this remarkable growth. First off, let's delve into SoundHound's revenue. The company saw a remarkable growth from 2021 to 2023. In 2021, the revenue was comparatively modest, but by 2023, it had more than doubled, reaching $45.9 million. That's a year-on-year growth of 47% from 2021 to 2022, and an impressive 48% from 2022 to 2023. Now, where does this revenue come from? 41% of it comes from licensing, with hosted services not far behind, comprising 40%. Professional services contribute 18%, and the remaining 1% is classified as other. And what about the geographical distribution of revenue? Half of SoundHound's revenue comes from Korea, followed by 15% from the United States, 13% from Germany, 9% from France, 8% from Japan, and the remaining 5% from other parts of the world. It's clear to see that SoundHound has a diverse revenue stream, both in terms of service offerings and geographical reach. This diversity is a strength as it reduces the company's dependency on any one source of income or market, making it more resilient to changes in market conditions. Impressive growth, isn't it? But how does this translate to profit? Now let's examine SoundHound's profit margins. SoundHound's gross profit margin for 2023 was 75%. A healthy number indeed. However, the net profit margin told a different story, standing at a staggering negative 200%. Why such a negative net profit margin, you may ask? This discrepancy arises primarily from SoundHound's heavy investments in research and development and sales, general and administrative expenses. In 2023, R&D expenses accounted for 112% of revenue, while SG&A expenses made up 103%. Essentially, these two costs alone exceeded the revenue SoundHound generated. However, it's not all doom and gloom. There is a silver lining here. Between 2021 and 2023, there's a clear downward trend in the proportion of R&D and SG&A expenses. This is a positive signal. If SoundHound continues to streamline these expenditures, we might see the net profit margin venture into the positive territory in the near future. Despite the negative net profit margin, SoundHound's net loss in 2023 was $92 million, showing a decrease from the previous year's loss of $117 million. This reduction in loss, coupled with the downward trend in expenses, suggests that SoundHound is taking steps towards profitability. SoundHound's high R&D and SG&A expenses are a concern, but there are signs of improvement. Next, let's review SoundHound's assets and liabilities. Now, as we delve into the financial health of the company, it's essential to understand what we're looking at. Assets are everything the company owns that has value, while liabilities are what the company owes. The difference between the two gives us the net assets, which is essentially the company's equity. In 2023, SoundHound's total assets were an impressive $151 million. That's a significant leap from the $38 million reported in 2022. On the other side of the balance sheet, we see net assets of $28 million in 2023, a favorable turn from the negative $37 million in 2022. One key indicator we can look at is the equity to total assets ratio. This ratio gives us a quick snapshot of the financial structure of the company. In 2023, this ratio stood at 19%, a massive improvement from the negative 96% in 2022. But let's not stop there. The current ratio is another critical metric to consider. This ratio tells us whether a company has enough resources to pay its debts over the next 12 months. A higher number is usually a good sign. In 2023, SoundHound's current ratio was a robust 4.69, a significant improvement from the 0.46 in 2022. This improvement is largely due to an increase in capital in 2023. So, what does all this mean? Well, the increase in total assets, the positive net assets, and the improved ratios suggest that SoundHound's financial health is on an upward trajectory. But remember, while assets and liabilities give us a good picture of a company's financial health, they are just part of the story. SoundHound's financial health has improved significantly, but what about its cash flow? Let's now focus on SoundHound's cash flow. It's an essential part of any financial analysis because it provides a clear picture of a company's financial health by showing how money flows in and out of the business. In 2023, SoundHound's operating cash flow, the cash generated from the company's core business operations, stood at negative $92 million. This figure might give us pause, as it indicates that the company's primary activities were not generating enough cash to sustain its operations. When we look at the free cash flow, the cash left over after a company pays for its operating expenses and capital expenditures, we find a similar trend. SoundHound's free cash flow was also negative, at $69 million. This suggests that the company was not able to generate enough cash after its expenses to pursue opportunities that enhance shareholder value. However, it's worth noting that these figures represent an improvement from 2022, when the operating cash flow and free cash flow were both significantly more negative, at negative $117 million and negative $95 million respectively. These numbers show that while SoundHound's cash flow was negative in 2023, the situation has been improving. However, a negative cash flow is still a concern, as it indicates that the company's financial health is not yet solid. SoundHound's negative cash flow is a concern, but let's look at the bigger picture. Finally, let's conduct a Dupon analysis of SoundHound. The Dupon analysis is a financial ratio that we use to analyze a company's ability to increase its return on equity, or ROE. ROE is a measure of financial performance, calculated by dividing net income by shareholders' equity. Essentially, it measures the profitability of a company in relation to stockholders' equity. To break it down, RO is composed of three parts: net profit margin, asset turnover, and equity multiplier. Let's delve into each of these components. Net profit margin measures how much of each dollar earned by the company is translated into profits. In 2023, SoundHound had a net profit margin of negative 200%. While this might seem concerning, it's important to remember that SoundHound has been heavily investing in research and development, which can lead to higher expenses and lower net profit margins in the short term. Next, we have the asset turnover ratio. This measures how efficiently a company uses its assets to generate sales. For SoundHound, the asset turnover for 2023 was 0.49, indicating that for every dollar in assets, SoundHound generated roughly 50 cents in sales. Finally, let's look at the equity multiplier. This measures a company's financial leverage. SoundHound's equity multiplier in 2023 was 5.35, indicating that the company has been financing its assets through debt more than equity. SoundHound's performance shows promise, but there are still areas that need improvement. To wrap it up, let's revisit our initial question. If you had invested $1,000 in SoundHound in 2022, by March of 2024, your investment would have grown by 119% to $2,187. This impressive growth is largely due to SoundHound's robust revenue development, driven by diverse revenue streams and geographical spread. Despite negative net profit margins, largely due to heavy investment in research and development and sales, general and administrative expenses, there are promising signs of improvement. The reduction in losses and the improved liquidity position point towards a promising future, where we may see positive net profit margins. However, negative cash flows and a high negative return on equity are areas of concern that warrant close monitoring. Stay tuned for more insightful financial analyses, and don't forget to subscribe and comment which company you want us to analyze next.